right, we are going to look at the liabilities worksheet. So this video will go with your worksheet, and so you want to use that this video to help you complete the worksheet. The first question on the worksheet states, a 1-year loan in the amount of $100,000 with a 12% interest was taken out on June 1st. And it wants us to calculate the interest for or as of December the 31st. Now the hint on your worksheet is that we're looking at June 1st through December 31st. So if we do that, we have June, July, August, September, October, November, December. So that is for 7 months is what we are looking at. So we have 7 months that we will be calculating this interest for. So once we have that figured out, then we can actually look at figuring out how much the interest is going to be. So what we do is we take the principal, which was $100,000, we multiply it by the rate, which was 12% for a whole year, and that would actually give us $12,000 for the whole year, but we don't need the whole year. We only need June 1st through December 31st. And so that is 7 months. So what we would do is we would take 7 over 12, and that's the time. So you take principal times interest rate times time, and what we end up with is $7,000 is how much we would actually have that would be our interest from June 1st to December 31st for that 7-month period. The next thing says prepare the journal entry for issuance of that note payable. So we do have a note payable here. If we owe somebody something, that's because we have gotten money in. And so when we would issue this, what we would have is on June 1st, you would be getting cash in the amount of $100,000, and the other side of this is going to be that note payable. Don't forget to indent your credit account, and then of course you're also going to have a credit column. So we would have cash as our debit account for $100,000, and the note payable would be for $100,000 as well, that has to be paid off in the future. C was prepare the adjusting entry for the interest expense, and the hint was you found the amount in A. So this is doing the adjusting entry, and we're doing this as of December 31st, but remember we're having to calculate that interest expense from June 1st to December 31st, which is what we found in A. So for this particular entry that would be made on December the 31st, what you would have is you would have the interest expense, and remember for A we found the amount was $7,000, and the other side is going to be the interest payable, because remember this has not been paid yet. We actually would be paying this in the future when this note comes due, which would be around May 31st is when it would actually be coming due. So on December 31st, we're just looking for that 7 months interest, and that is going to be an interest payable amount. The last thing is to prepare that journal entry at maturity. So at maturity, what we are looking at is we are going to have to pay out cash for that note payable amount. And then we also need to pay that total amount in interest. And remember, for the full year, that interest amount was $12,000. And you get that interest amount by looking at the principal times that 12%, which is that annual interest rate, which gives you the $12,000. So our cash value here, and what we're going to have to pay out, is going to be $112,000. The way this is broken up, and this is going to be, of course, on that May 31st when we actually pay this off, the cash is going to be going out, so it's going down. It's going to be on the bottom for 112. What we're going to have for our debit accounts is we are going to be getting rid of our note payable account, and our note payable was valued at $100,000. We also have interest payable for those first 7 months, and that was $7,000 that we have to pay. And the other part of this entry is that interest expense, and that's what's going to help us balance out this journal entry. And it's actually going to be for $5,000. Now, the way that number can be found is what we're looking at is January the 1st through May 31st. So when we look at 1/1 all the way through, 5/31, what we see there is 5 months. And so we would have to calculate this based on those 5 months. So if you took the 100,000 times 12% times 5/12, that gives you that 5,000 in interest expense for those 5 months of this particular year. And that allows it to balance out. So again, we are looking at our note payable, and we're getting rid of that because it's being paid off. Interest payable, that's being paid off, and the other is for the 5 months of interest for this particular year, which would be the 5,000, and that's a total cash payment of $112,000. So that is how those note payable entries would actually look. The other item that we look at on this worksheet are bond issuance, and that's really all that you have to know for that long-term liability chapter is how we issue a bond when we're actually looking at these journal entries. It's the only journal entry that you have to do is to issue that particular bond. So what we see here is we issue a $100,000 in bonds at face value. So if you're issuing out a bond, that means that somebody is giving you cash. And so they're going to be giving you cash here if it's issued at face value for $100,000, and then you're going to have this bond payable out there where you're going to owe that money back to them in the future for that $100,000. And so this is at face value. Face value just means that whatever the face value of that bond is how much money you're actually going to be getting. The next one we look at is it says we are going to issue a $100,000 bonds for 98. Now this 98 actually means 98% of the face value. This is what we call a discount because it is sold below face value. So our face value is at $100,000. We are only going to receive cash at 98% of the face value. So we will only be receiving cash in for $98,000. So we have that cash. We are looking at $98,000. Remember, we have that bond payable sitting out there, and we're going to owe them $100,000 when it's all said and done. Now, in this case, my debits do not equal my credits. I need another $2,000 on that debit side, and what that's going to be is a discount on the bond payable. So that's a discount on bond payable is what I would have for this particular journal entry. The last journal entry for bonds deals with a premium. So a premium is when we sell above face value, so above that $100,000. What we see here is that 101 means 101% is what we're selling it for. So to find the amount of cash that we would get in, we would need to take the face value of this bond, multiply it by that 101%, and when we do that, what we are going to get for our total is $101,000. So here we are going to have cash coming in at $101,000. That bond payable will be at the face value, which is $100,000. Notice again, debits and credits don't match. I need an extra $1,000 in my credit column, and what this is going to be, because it's sold above the face value. So we would have a premium on the bond payable amount for that $1,000. And so this is what we would look at as far as our journal entry is concerned. We're getting $101,000 in. We have a premium on bond payable for $1,000, and our bond payable is for $100,000. So just remember that whenever you see it and it's not sold at face value, what you're looking at is a percentage. So 98 means 98%, 101 means 101%. You will have to do all three of these issuance on your final test. The other item that we look at here is warranty. So warranties are contingent liabilities. In other lectures that I have on Blackboard, we talk about contingent liabilities. This is a contingent liability that we can estimate the amount for it, and it's probably going to happen. So we would actually have to do a journal entry for this type of contingent liability. So what we have on our worksheet is Blake Department Store sells television sets with 1-year warranties that cover repairs and replacement of television parts. In the month of June, Blake sells 40 television sets with a per unit cost of $500. If Blake estimates our warranty fulfillment at 10% of sales, what would the warranty be that would be reported in June be? And that's that first question that we're looking at. And so what we have to do for this one is we would take those 40 televisions that we sold, multiplying by the sales price, which is at that $500. So we have $500 as the sales price, 40 television sets. That equals sales of $20,000. Now it does say 10% of sales, so we would take our $20,000, we would then multiply that by that 10%, and we would be at $2,000 is what our journal entry amount is going to be for that warranty expense or warranty liability. So the journal entry that for this adjusting entry that we would do at the end of June, so this would happen at the end of June, we have 6/30, and so what we would have is we would have a warranty expense for that $2,000, and then we would have a warranty liability for that $2,000, and this way we can keep track of that liability and what we would see if something happened that did come in under warranty. As that comes in, we would take it out of that warranty liability account. So let's just say we had, $200 that was part of this liability expense, and it would come out of maybe our parts and labor account that we would have, but it would come out of that that warranty liability is what we would be looking at in that particular case. So it would reduce the amount that we would actually hold in our liability account if we actually had to take it out. And so this could happen at any point in time. So let's just say, this liability on 8/1 is when it occurred, and it was for that month of June. We do this because we have to do that matching principle, and so we want to make sure that our liabilities and our expenses are recorded and are matched with the period in which that was sold. The last entry that we have here is that a client pays cash in advance for a magazine subscription to Living Daily of $120, and that is for 12 magazines. Living Daily has only provided 2 magazines as of December 31st, and so we want to know what is that adjusting journal entry going to be in this case. So this is a case of unearned revenue. So we have the $120 is unearned whenever it was issued out, and they have done 2 magazines. So we really need to know how much is out there per magazine. So if we do it the $120, divide that by 12, what we find is we are earning $10 per magazine. Well, they have actually provided 2 magazines. So since they provided 2 magazines, they have earned $20 of that money. And so what we would see as our adjusting journal entry here is you would see that unearned subscription revenue for $20, and our credit account is going to be for the subscription revenue, is kind of what you would be looking at there. So what we've done, so that you can kind of see it, when we had that unearned revenue initially in the account, it was put in for $120. At this point, we've earned 2 months of it, and so now that account is only going to have $100 in it that we still have to earn. So each time we send out a magazine, we will earn $10 of that total. So these are those journal entries that you will have to know for the last test. So I think it's test 4 for you guys, which is going to cover, I think, 11, 12, and 13 in your textbook. So those are things that you will have to know how to do. The final test will actually be one that you pen and paper it, and you'll actually have to do those journal entries on the test. So it won't be multiple choice, it'll be you actually doing the journal entries. So you do want to make sure that you understand the material and that you can work this worksheet.